Which investing strategies could make you a fortune? Timing the market. Investing immediately? Dollar cost averaging? Should you time the stock market? Does market timing work? Imagine for a moment that you have just received a year-end bonus or income tax refund. You're not sure whether to invest now or wait. After all, the market recently hit an all-time high. Every investor faces this kind of decision every year, sometimes in up markets and other times in downturns. Is there a good rule of thumb to follow? Let's consider the performance of 5 investors following 5 investing strategies. Suppose each of them received $2,000 at the beginning of every year for the 20 years ending in 2022 and left the money in the S&P 500 stock market. Let's check out how they performed over time. Mr. Perfect was a perfect market timer. He had incredible skill or luck and was able to place his $2,000 into the market every year at the lowest closing point. For example, Mr. Perfect had $2,000 to invest at the start of 2003. Rather than putting it immediately into the market, he waited and invested on March 11, 2003, that year's lowest closing level for the S&P 500. At the beginning of 2004, Mr. Perfect received another $2,000. He waited and invested the money on August 12, 2004, the lowest closing level for the market for that year. He continued to time his investments perfectly every year through 2022. Mr. Action took a simple, consistent approach. Each year, once he received his cash, he invested his $2,000 in the market on the first trading day of the year. Mr. DCA divided his annual $2,000 allotment into 12 equal portions, which he invested at the beginning of each month. This strategy is known as dollar cost averaging. You may already be doing this through regular investments in your 401k plan or an automatic investment plan, AIP, which allows you to deposit money into investments like mutual funds on a set timetable. Miss Bad Luck had incredibly poor timing, or perhaps terribly bad luck. She invested her $2,000 each year at the market's peak. For example, Ms. Bad Luck invested her first $2,000 on December 31, 2003, that year's highest closing level for the S&P 500. She received her second $2,000 at the beginning of 2004 and invested it on December 30, 2004, the peak for that year. Miss Linger left her money in cash investments, using treasury bills as a proxy, every year and never got around to investing in stocks at all. She was always convinced that lower stock prices and better opportunities to invest her money were just around the corner. Are you ready for the results? For the winner, look at the graph, which shows how much hypothetical wealth each of the 5 investors had accumulated at the end of the 20 years. 2003 to 2022. Naturally, the best results belong to Mr. Perfect, who waited and timed his annual investment perfectly. He accumulated $138,044. But the study's most stunning finding is Mr. Action, who came in second with $127,506, only $10,537 less than Mr. Perfect. This relatively small difference is especially surprising, considering that Mr. Action had simply put his money to work as soon as he received it each year without any pretense of market timing. Mr. DCA's dollar cost averaging approach performed nearly as well, earning him third place with $124,248 at the end of 20 years. That didn't surprise me. After all, in a typical 12-month period, the market has risen 75.4% of the time. However, Mr. Action's pattern of investing as soon as receipt did yield lower buying prices over time than Mr. DCA's monthly discipline and, thus, higher ending wealth. Ms. Unlucky's results also proved surprisingly encouraging. While her poor timing left her $15,214 short of Mr. Action, who didn't try timing investments, Ms. Unlucky still earned $112,292, about 3 times what she would have if she hadn't invested in the market at all. And what of Ms. Linger, the procrastinator who kept waiting for a better opportunity to buy stocks and then didn't buy at all. She fared worst of all, with only $43,948. Her biggest worry had been investing at a market high. Ironically, had she done that each year, she would have earned far more over the 20-year period. The rules generally don't change. Regardless of the time period considered, the rankings turn out to be remarkably similar. We analyzed all 78 rolling 20-year periods dating back to 1926. For example, 1926 to 1945, 1927 to 1946, etc. In 68 of the 78 periods, the rankings were exactly the same. That is, Mr. Perfect was first, Mr. Action second, Mr. DCA third, Ms. Bad Luck fourth, and Miss Linger last. But what about the 10 periods when the results were not as expected? Even in these periods, investing immediately never came last. It was in its normal second place 4 times, third place 5 times, and fourth place only once. From 1962 to 1981, one of the few extended periods of persistently weak equity markets. What's more, during that period, fourth, third, and second places were virtually tied. We also looked at all possible 30, 40, and 50-year time periods, starting in 1926. If you don't count the few instances when investing immediately swapped places with dollar cost averaging, all time periods followed the same pattern. In every 30, 40, and 50-year period, perfect timing was first, followed by investing immediately or dollar cost averaging, bad timing, and, finally, never buying stocks. What does this mean for you? If you make an annual investment, such as a contribution to an IRA or a stock brokerage account, investing immediately or DCA should always be your course of action. Even if you're not sure whether you should invest weekly or monthly, be decisive when you choose the DCA investing strategy. The best course of action for most of us is to create an appropriate plan and take action as soon as possible. It's nearly impossible to accurately identify market bottoms on a regular basis. So, the best action for a long-term investor like us is to determine how much exposure to the stock market is appropriate for our goals and risk tolerance. Then, personally, I would invest as soon as I receive money, regardless of the current level of the stock market. Why do I like to invest as soon as cash comes in? Because it would be the easiest way for us to remember to invest. Other strategies may not give the best outcomes, or we may just simply forget to invest. If you're tempted to try to wait for the best time to invest in the stock market, our study suggests that the potential benefits of doing this aren't all that impressive, even for perfect timers. Remember, over 20 years, Mr. Perfect amassed just $10,537 more than Mr. Action, who put his cash to work right away. That's about $500 extra per year. Even badly timed stock market investments were much better than no stock market investments at all. Our study suggests that investors who procrastinate are likely to miss out on the stock market's potential growth. By perpetually waiting for the right time, Ms. Linger sacrificed $68,304 compared to even the worst market timer, Ms. Bad Luck, with $102,292, who invested in the market at each year's high. If you don't have the opportunity or stomach to invest your lump sum all at once, consider investing smaller amounts more frequently. As long as you stick with it, dollar cost averaging can offer several potential benefits. DCA prevents procrastination. Some of us just have a hard time getting started. We know we should be investing, but we never quite get around to it. Much like a regular 401k payroll deduction, dollar cost averaging helps force yourself to invest consistently. DCA minimizes regret. Even the most even-tempered stock trader feels at least a tinge of regret when an investment proves to be poorly timed. Worse, such regret may cause you to disrupt your investment strategy in an attempt to make up for your setback. Dollar cost averaging can help minimize this regret because you make multiple investments, none of them particularly large. DCA helps avoid market timing. Dollar cost averaging ensures that you will participate in the stock market regardless of current conditions. While this will not guarantee a profit or protect against a loss in a declining market, it will eliminate the temptation to try market timing strategies that rarely succeed. That said, if you use dollar cost averaging instead of lump sum, you need to keep some things in mind. If the stock price rises over time, continuing to buy throughout the year will result in an increased average price per share. That would cause you to miss out on possible gains. However, if the stock falls over time, you will keep buying at lower prices. But there's also no guarantee that the stock price will recover. As you strive to reach your financial goals, keep these research findings in mind. It may be tempting to try to wait for the best time to invest, especially in a volatile market environment. But before you do, remember the high cost of waiting. Even the worst possible market timers in our studies would have beaten those who neglected to invest in the stock market at all. So, what are the investing lessons that I want to give you here? Given the difficulty of timing the market, the most realistic strategy for the majority of investors would be to invest in stocks immediately. A procrastination can be worse than bad timing. Long term, it's almost always better to invest in stocks even at the worst time each year than not to invest at all. Dollar cost averaging is a good plan if you're prone to regret after a large investment has a short-term drop, or if you like the discipline of investing small amounts as you earn them. Then lastly, it's important to note that there's no guarantee you'll make money through investing in stocks. For instance, there's always a chance we could enter another period like the 1960s through early 1980s. Our research shows that the cost of waiting for the perfect moment to invest typically exceeds the benefit of even perfect timing. And because timing the market perfectly is nearly impossible, the best strategy for most of us is not to try to market time at all. Instead, make a plan and invest as soon as possible. What do you love most about this video? Share and subscribe Master Rich Stocks Options Cryptos for more videos like this. Check out my playlist for more videos on stock investing, option trading, and other investment education. See you in my next stock, option, and crypto videos.